Hi, folks. This is Mike Zlotnik, Big Mike, and this is a short commentary on this week's most important economic activities. First of all, the Fed Board of Governors met. It was July 30th and 31st, and then the Fed Chair, Jay Powell, provided commentary on July 31st. And also, we received fresh unemployment data on Friday, August 2nd. So just a couple of comments about the Fed meeting and what Jay Powell signaled, as well as how stock and bond markets responded to both of these events. So first of all, the Fed has decided to keep the rate steady, make no change in July, but have signaled their higher confidence that the inflation is cooling, as well as that employment is growing. And the dual mandate is such that they have to be working to reduce the inflation to their target of 2%, as well as to keep maximum employment or full employment. It would appear that their mandate to achieve steady prices, or price stability as they call it, is almost complete, although they do want to see a little more data. Current inflation rate stands at 2.5%. The target is at 2%, but it's moving steadily towards 2%. So their focus is shifting to the full employment, which is basically dealing with the increasing unemployment rate. So as of the meeting on July 30th and 31st, unemployment rate was 4.1%. As of Friday, August 2nd, the most recent data came out with a soft new hiring. Unemployment rate jumped to 4.8%. So all these are likely indications that the Fed will act in September and cut the rates for the first time since their last hike, which was July of 2023. As far as further cuts, they are maintaining the optionality. Fed Chair Jay Powell properly managed to divert questions from reporters, essentially saying them that it's all data driven, telling them that they will make decisions based on what happens in the economy and the future data, which makes a lot of sense. A lot of folks are speculating that September rate cut is locked in, which I happen to believe that that's a very likely possibility. There will be two more meetings later in the year, one in November post-election, and then the following one in December. So my position is that post-election, the Fed is likely to move faster. So November and December rate cuts are also a probability, probably significant likelihood that they will act if the unemployment continues to grow and inflation data is under control. So we might see 3 rate cuts of a quarter this year, although all of this depends on data. So this is pretty important. Now, how did the bond and stock markets responded? So stock market showed 2 days of significant nervousness and volatility. Significant price corrections took place. At the same time, in parallel, bond markets continued to, the yields continued to drop and drop significantly. So let me just show you very quickly the most recent snapshot as of this morning when I'm recording it on Friday, August 2nd. The 10-year Treasury yield is 3.85%. Just to be very clear, 10-year Treasury yield is not what the Federal Reserve controls. Federal Reserve controls just the Fed funds rate. They left it at 5.25 to 5.5 target, which is significantly higher than the 10-year Treasury yield. The market is way ahead of the Fed action. The market is fronting for Fed action. The market is recognizing that the inflation has come down and the risks to the economy of a recession have increased significantly. So as a result, the market is correcting. Not long ago, as you could see on this graph, we were at a 4.25. Now we're at 3.85. So the trend is significant correction, although markets do bounce up and down. But it would appear that we've crossed the 4% 10-year Treasury yield and going down at a meaningful pace for now, the last couple of days. What does it mean for commercial real estate? Tailwind, significant tailwind on the folks who are looking for fresh financing or refinancing. Sensitivity to even a quarter rate drop in the 10-year Treasury yield is pretty significant. Most of the mortgages in the commercial real estate, 5-10-year mortgages, are linked to the 10-year Treasury yield. That drives the cost of money, the interest rate on the financing or refinancing of commercial properties. So it's helping the cash flows. Now, what will it do for the future valuations? The general theory is that it has worked on a historic basis. That as interest rates increase, the cap rates increase, valuations fall. As interest rates come down, cap rates come down, and valuations increase. Now, it may take time for these events to shake into the system, but at least this is a welcome news for the commercial real estate, as it would appear the September rate cuts is baked in. 10-year Treasury is already telling us this is happening, and we're directionally moving down on the long-term rates, and the short-term rates will appear to follow at the speed that the Fed wants to move them, and then I'll respond to data over time. So that's the analysis that I'd like to put forward. And what's really interesting, and I'm not purely speculative, of course, who knows what's going to happen. Stock market is very nervous. Volatility has increased. VIX volatility index shot up. Prices are falling or have fallen. And many investors are nervous. They are shifting to the safety of bonds, buying bonds in the expectations that the yields will continue to fall. Now, this becomes really interesting for folks who can shift their capital outside of stock markets into alternative investments such as commercial real estate, because the opportunities in commercial real estate are significantly better in this environment. That's another conversation. Feel free to tune in. I see gradual recovery, at least may not start immediately, but if the rates continue to drop, it's a significant tailwind, and I'm cautiously optimistic about the future of commercial real estate. We've had a couple of very difficult years with Fed hiking and keeping the rates at this historically high level. Well, for the last 30 to 40 years, these rates are pretty high on a relative basis. Of course, in the 80s, the interest rates were significantly higher, but the rate of change that the Fed implemented when they hiked was so fast and furious that it dislocated the market. Now, as they start cutting, we welcome the tailwind, and it might significantly help the markets, may become to act like stimulus to the commercial real estate markets, although time will show. So appreciate your time and attention. Until the next time, have a great weekend. Thank you.